Matron, take them away.
Okay guys, coming on to top of the hour, so we'll kind of get started. A little bit of housekeeping. Tonight's just kind of an open Q&A. Very, very simple. Ask your question and I'll try and answer it. All of the super chats, etc., go to St. Cuthbert. So if you want to sort of donate into that, happy days. You'll find a button at the bottom of the chat. And also every one of them gets bumped up to the top. And if I can't get to the question, I'll either make a video on it or I'll bring it up in the next live stream. So that's it. So let's have a little look, see who we've got. And then I'll start trying to catch up some of the answers. So we've got Mackin, Luma, SB, how are you? John, Stephen, oh, he's working. That's no good. Kathy, pull up a picture. Phil, Jeff, Grant, great to see you. EE, how's Cyprus this time of the year? Jeremy and Marky. Excellent, excellent, excellent. Okay. Just to put a little bit into context before we start, I'm going to show you a couple of polls that I put out, and then I'm going to explain what I'm doing going forward, because at this time, it's a new tax year for me starting tomorrow. So it's effectively a clean slate for me. So everything will be sort of set to zero. And I put a poll out. I'll kind of show you here, which is, what do you want to see? What do you want to see in the channel? Because for all it's a hobby for me, a lot of people do like to follow it. And it's kind of down the middle as to whether you want to see my wage account, which is half decent money, or do you want to see me build small accounts? And it's kind of split down the middle. So I thought, right, I'll do a bit of each. I'm still going to do MT5 on a Monday for people that trade prop or like MT5. But then I'll build up a small account so you can see a small account, because believe it or not, they're actually more stressful than a big account. When you've got a big account, you can buy your way out of trouble. You can sort of open up different positions. So if you're sort of caught in a trade that's going to take 2 or 3 days, you're not waiting, you can open up another one. Big accounts can allow you to do that. With a small account, you can't. You've pretty much got to nail it every time. And you also haven't got the ability to split your trades up either. So you've got to nail it on the head as well. So it's actually really difficult to trade a small account. Now from there, I put a little poll up as to kind of roughly what size account do you want me to start with. Now, there is the misconception that you can turn a very, very small amount. And I'll give a salute to SB, because she did make a suggestion, but it was way too low, SB. To start building from £10 up into a decent size account will take a hell of a long time, but it gives you nowhere to go. And as a word of advice, it takes money to make money. So you've got to have half decent chance in the account. And I'm quite pleased that they've actually put in about the 500 quid mark. So that's what I'll do, is I'll take a wage builder account, I'll round it up, make 500 quid, and then I'll do little accounts with that. So hopefully that might spark you guys up. And from there, maybe inspire you a little bit as well. So let's have a little look, see where we're up to, and we'll get this show on the road. So bear with me a second. I just need to switch a couple of things on. Okay. Now, I did get an email through, and it was regards pivots. Now, if you bear with me, I'm just going to refresh my memory. The question's from Phil, so it's a little salute to Phil. And it is in anticipation of the live stream. He's got a question on pivot points. And the example is the pivot point's a difference between future CFDs and even IG calculation. Which is the best one to use and which is relevant in my opinion? It doesn't matter, to be honest. If you're trading options, you use the pivot that's on the options chart. Basically, you use the chart that is in front of you that you're going to trade. Okay. We had a similar query in the Zoom calls we have with the squad about timescales. When we're talking to Mark, Aussie Mark, so salute to you, Mark. His time of day is different to my time of day, obviously because of the time zones. So when my candle starts at 12 o'clock at night, his was back about 10 o'clock. So there's always a 2-hour shift on the daily. So his pivots were slightly different. However, if you balance it out and you're just looking at the pivot you're trading, in other words, the chart, then it's fine. You can confuse yourself way too much. And if you haven't seen a pivot, I'll show you one. Just quickly click this over. It's a very, very simple indicator. We'll just switch all of these indicators off for now. And we'll pull up a pivot. Okay. And I'll make it thick just so you can kind of see it. There you go. All right. So your pivot is there. Okay. If you're only ever trading sort of cable and you're on a spread bet account, then stick to that chart and don't confuse yourself jumping from one to the other, because charts do change. They change from broker, they change from instrument type. Trade what you see. Okay. So in this case, the rule of thumb would be identical across the board. If it opens above the pivot, it'll try and go to R1. If it opens below pivot, it'll try and go to S1 first. So I can give you a good example. So here, there's your pivot opening, which is this candle. Yes, it's above an S&R line, but where did it go to? It went straight to R1. And you'll be surprised how often that happens. So if you've already got a sort of a bias in mind, say you want to be at the upper side of a Bollinger Band. So if we drop a Bollinger Band on for argument's sake, here, and you can see the price is in the upper quadrant of a Bollinger Band and it's opened above the pivot, well, you've already got your target point, which is here. And that makes life so much easier. So in answer to Phil's question, it's a case of trade what you see. Don't chop and change the charts. Don't try and sort of think, well, this is happening here, so it must be doing something over there. You can actually confuse yourself way too much. Keep it as simple as possible. If you're trading options, stick with options. If you're trading CFD, stick with a CFD chart. If you're on a spread betting chart like mine, stick with a spread betting chart, because the only thing that you're interested in, it's not the price of the product, it's the movement of the product. These things here. These numbers down here mean jack all, because you can start confusing yourself. What you want to be looking at is swing points and definitive points of the chart you can recognize without any numbers on the side. So you can recognize a swing, you can recognize a support resistance level, you can recognize a pivot, and then you can build a framework. Sometimes you can just be way too complicated in your situation. So let's have a quick look through the questions that started, and I'll work my way down and we'll see how we get on. Okay. So, Scruff, what different times and markets do you talk about, i.e. New York versus Asian? I know, well, personally, I trade the London session with a crossover into the New York session. However, occasionally I do come into the Asian session to help the guys. So I actually talk across the board. But what I'll say is, sometimes, again, it's a little bit like the question with the pivots. You can get yourself too wrapped up in it. All we're looking for is movement in the charts. Now, London is the fastest session there is, because obviously it's the close of Asia and it's the open of New York, and you've got London sandwiched in the middle. So there's lots of money coming in and out of it all the time. So that's the fastest market, which will give you the best opportunity for the biggest target, all right? Or the fastest target, I should say. Then you move into the New York. It's still pretty quick and it's still good money, but it starts slowing down. And then you'll move into Asia, which moves right down, slows considerably. But it's not to say you can't get any money out of it. The movements are the same. They're just not as fast. And I've proved it. I've gone on and I've said, right, this is going to do X, Y, Z. But instead of getting it done in 20 minutes, I might have to wait an hour and a half for it. It's just speed of movement. So don't worry about that. So Lumar, let's have a look. You use SNR levels as well as fibs. In what situation would I prefer an SNR before a fib and vice versa? Right, okay. I use them in conjunction with each other, to be honest. It's not a question of using one over the other. What I'm looking for, if you ever see a dotted line, it's a fib line, okay? And where you can see a fib sitting on a support and resistance, what that does is that gives me greater weight as to what's going to happen here, okay? So if I'm looking at here, that would catch my eye a lot more than that, because I have the fib reinforcing the support and resistance. Now, support and resistance comes from tried and tested price action. In other words, it's a clear turning point in the market. A fib is a hypothetical turning point based on 2 points, a definitive high and a definitive low, and then obviously it's the ratios between the two. Now, if they coincide, in other words, say 23 lines up with a solid support and resistance, that has stronger weight than just this, because it's shown its hand. But then I'll take it a bit further, just to kind of case in point. I'll use the most recent move. If you can recognize a move like this, which clearly you can see a definitive low and a definitive high. I'm just going to get rid of that. You can draw a fib on it. So you get your fib, and I'll show you how to draw this in as well. Now, fib starts with the first color of the move. What I mean by that is, if you're going long, you want the first candle of the move, the green one. So you can see that all of the reds have come to an end. There's the first green signaling this movement, and we can recognize this movement clearly. There's the top, there's the bottom. And even if you got in down here, you know, you've had 1, 2, 3, 4 hours to recognize that that's over. There's another way of recognizing it's over as well, which is this candle here. Now this is, well, you call it starburst, a hammer, whatever you like, but I just call it a long tail. So you've got a long tail showing a lot of downward pressure, small body. The next candle is showing you that there is sort of indecision, because you've got tails either side and a very small body. Then you've got a red candle coming in, poking down, and that's telling you this is over. Okay, so you can draw your fib in. Then you've got a definitive entry point, which is this 23, and then you've got definitive exit points, which are the 38 and the 50, running down into 61, and then eventually 76. And if you look at the way this is made up, so there's your definitive move, there's your 23 as your entry, you've got 1, 2, 3 hours to recognize it, triggers in, and then where's the price stall? Well, what do we know? It's stalled on the 38, it's stalled on the 50, it's stalled on the 61, and then it's even as it's continuing to break down, stalled on the 76. So it maps out the entire move for you. So that's why I use them. I use them quite a lot, just simply because it does break the chart up for me fully. So I hope that kind of helps and explains that a little bit. Let's have a look. SB, your thoughts on ITC? Oh God, everybody talks about ITC. I'm not big on ITC concepts because I started watching it because it's the buzzword, and I literally got about 5 minutes into it and thought, I just can't be chewed with this. But the basic principle that I get from it, it is you're selling high. They'll call it sort of like premium and discount, which is based on a high and low. Looking at liquidity draws, well, liquidity draw is just really a turning point in the market. So your support and resistance will give you that anyway. And the other side of it is what they call a fair value gap, gets banged around a lot. Now, many moons ago, in fact, before this ITC 2020 came out, or 2022, I was talking about daddy levels donkeys years ago. That's the markup of the daily. It's just a daddy level. It's the high, low, open, close, midpoint, which seems to be the makeup. And then you have a 3-candle pattern, which is, well, I'll show you. Let's see if I can show you. There is a 3-candle pattern given a fair value gap, which is here. And what it is, it's a candle here, an overextended candle, a return that doesn't meet that, leaving a gap between these two candles here. Now, if you bear with me, I'll just be able to show you it, which is there. Okay, so it's a 3-candle power shift, and what that means is there's an accelerant in a single direction. The sellers, buyers, etc. create this, which is an overextended candle. When it returns, it doesn't reach here, creating an imbalance, which is this. And then that is used for entries. Now, how far you go down is up to you. I mean, there's a lot of people go down on 1 minute charts and things like that. To me, I just think it's a little bit noisy. But what I'll say about trading, if I was to put it into the simplest process, and it's not ITC, I'm not, like I say, I haven't followed it. I'm not really interested in it. I find it very subjective. So I just kind of dismiss it. I'm happy with the way I trade, and I don't want to muddy my waters. So the principle is very simple. Okay. It is a return to the mean. That's it. So you find your liquidity draw at the top. That bit runs out. It runs the stops, comes down looking for the next set to springboard it forward. And then you've got a meridian line in the middle, which they call equilibrium. It's running down into that. That's kind of the easiest way, but that's all trading is anyway. If you ever look at it on a bigger term, on like sort of a daily, the chart will always push up, it'll come down, it'll push up, it'll come down. But where the fair value gaps sort of, they kind of worry me somewhat. There's a one there, there's a one here, there's another one there, there's a one there. It's only ever filled one of them. So if you were targeting this down here, well, it didn't get filled. This one didn't get filled. And the talk of saying, well, they always get filled. Well, everything will get filled eventually because the markets constantly return back to the mean. Bull run and bear market. So that kind of makes sense. I know it's probably not the answer you want, but like I say, I'm not big on it, so it's not my thing. Let's have a look, see where we're at. John, well, we had a good grade. Could you tell me your thoughts on the best technical indicator for a beginner in a Forex market? Oh, that's a good one. I would say look at two, to be honest, rather than one. One of them definitely wants to be an oscillator. It can be a stochastic, it can be an RSI, whichever, but you want like a bounded oscillator. Personally, I like the RSI. The RSI, it's been around forever. I do manipulate it. If I want to see a big picture of the market, I'll put it on a 28 setting. Slows everything down and you can kind of see what's going on in a longer term. Does that work fine for a 5-minute chart? Not really, but 4 hour and a daily, it's excellent. It kind of shows you where the dominance is. And then from there, I would also look at a Bollinger Band, because the Bollinger Band will show you the stretch points of the market. But don't take them as gospel. Take them, let me just show you a second. If I drop on an RSI, and I'll kind of show you a couple of settings on this thing. And we just put this on a 50 line, like so. What this does, you can see how long it stays that way. And, well, the colors are actually upside down. That should be green, really, to highlight that it's going long, and this should be red. But it's a good visual aid, this. And then if I just drop a line on at 65, and I'll explain why I'm doing that as well. And then another one at 35. Okay. What this represents is it can tell you the direction of the market in an instant. If it's green, it's going up. If it gets above the black line, there is a retracement imminent. And because you've slowed this right down, what you're also doing is you need to compress the boundaries, because it will take forever to get there. So there's a crossing point there. You can see the last one, the red. Okay. And even the one prior to that. There's the crossing point. So if we just drag this line back here so I can kind of show you. There's a crossing point there. That stayed green quite significantly. Okay. So if you were looking for just some easy pips, let's have a look. What was that? Right. There's 52 pips on that cross. Okay. This one here, it's red. If you had your order underneath the candle, which you should, always let a candle come to you, that wouldn't get triggered. So it was a safe bet here, but then it turned round and shot away back up, which is this candle. So you would then put your order on here. Now, depending on how brave you are, how long you're holding it, etc. Before this came back down, so that's this red candle here, that got up to, that was a 711 move before it dropped off. Now, if you're following that up, you should be able to get plenty and plenty of pips out of that. But why is it a case of you use 2, not 1? Well, if you're only using 1, you would still be trying probably to go long again when this started to collapse. Now, what you need is some kind of filter to tell you not to do it. And if you put a Bollinger Band on, well, as that came up and it pierced, so it shot away, it's pierced here, here, this is telling you to be careful all the time. And as that came shooting up and that came back down onto this moving average, which is the first time it did it. So I'd still be careful with all of this here because of these. In other words, I'd be taking money out and scaling, etc. Once that came down and tagged that moving average, knowing that I've been on the outskirts of the Bollinger, I know it'll be running to the other side. So then I'll be looking to be very careful. So you kind of use 2 together. Oh, that one kind of helps to a degree. Okay, so where were we up to? So Stephen's at work, evening Kathy, and the rest of them are just the welcomes from earlier on. Okay, try and catch up, see where we're up to. Charmaine, how are you doing? David, Jeff. Oh my God, here he comes. The redneck's in. So is our resident alcoholic, Finny. Nick, how are you doing, my old friend? Hello. So, how much percentage did you pay on tax last year? 19%. I run my trades through a true business. Tax is a big thing when it comes to the markets. Nobody wants to pay tax. But unfortunately, if it's your sole income, and we had this argument a few weeks ago when we did a live stream, someone's going, nah, spread betting's tax-free. It's not. It's only tax-free if it's not your sole income. If it's your sole income or a sizable income, it then becomes taxable. And then it comes under corporation tax. And because I run it through a limited company, I pay 19%. And the other way I get that percentage down is obviously I claim for everything, electric in the house. If I buy a new camera, I can claim against that sort of thing. So happy days. But yeah, fantastic. But then it gets worse than that, because not only am I paying sort of 19% on my profits, I've got to pay it on dividends. I've also got to pay class 4 national insurance and all sorts of different things. It's a bloody nightmare. My advice is get a good accountant, and they look after you. I mean, all I do is I just give all my books to the accountant, and he just says, right, this is what you can claim, this is what you're paying, and that's it. So, yes, good idea. Yeah, I'm quite happy to do that, Jeremy. Definitely happy to do that. Do a 1K challenge. Well, it seems to be about, on the poll is about 500 quid. So I think a 1K challenge is a good amount of money to start with. But I'll go with what you guys say, and we'll stick around about 400 or 500 quid. 500 quid's a nice round number. Hi Bruce, hope you're well. Let's see if we can catch up with all of this lot. Let's work my way down. So hello Peter, you'll be moving here soon, are you not? You going to Scotland or something? So happy days, happy days. So pull up a picture. Notice a lot of tan on the mankini. Must have been worn and stuff. Yeah, we had a great time. I was recently in Cape Verde. I literally burnt out, guys. I burnt out beyond belief, and I just needed the break. And obviously you lot like to see the mankini, and I'm stupid enough to do it, so that's where the pictures came from. So happy days. Hello Malcolm. Let's see, Clayton. Clayton, gee, let's have a little look, shall we? So, just drop this down into preferred settings because I want to see it. Okay. Okay. Well, depends on what you think about the pound, because actually looking at this just as a quick picture, it's starting to close in and close down on itself. Well, if that's the case, and that's shown here as well, let's have a look at the weekly and see what the weekly's up to. We'll take these drawings off for now. Get the drawings off. We are I don't think it's as strong as you think, because it's catching the tops of here, it's bouncing the top of there. If it is going to move up, it's coming to the tops of this level. So that's 12,646. And then the next area would be here. But look at the candles. They are definitely slowing down. So I'd be... I keep half an eye on it. I'd want to see this in the morning, and I'd do analysis after the first. But I'd be very careful with it this week, actually. I wouldn't necessarily be thinking it's going to push up strongly. We'll see. We'll see what happens tomorrow. And happy days, happy days, happy days. So let's have a look, see what else we got. Press the like button, everybody. Yeah, that would be great. Catching up. Okay. If you wanted to build a small account, would you recommend day trading, swing trading? Right, okay. That's actually a really good question. I built mine initially as kind of a hybrid between the two, and I'll explain that. I predominantly day trade, and the idea is you get 10 pips as a minimum, and I mean a minimum. But what you're also trying to do is let a runner go, and you want to keep that running going as long as you can. So a good idea is to sort of open up a single position, 50 pence, because if you're on 500 quid, well, 50p is about the maximum that account can take. I work on sort of 50p for every 500, which works out about 10p every 100. Okay, but once it gets up to, say, my 10 pips or 11 pips, whatever the target is, I'll close off about 80% of the trade. Maybe just leave 10 pence running. Pull the stop to break even, so you can't lose. And if you are on a runner, and trust me, it doesn't happen that often, but you only need one or two that will run continuously, you know. So you get one or two a month that they just don't even look back. They just keep on going. That's where you start making some money, and they might run for a few days. So personally, I'm more on the side of day trading it. But if you are going to swing trade, you want to be looking at daily charts, a little bit like when I was showing that sort of RSI on a 28. Now, I was just using that as an example as to how manipulating the settings can actually show you a bigger picture. Well, you set 10p away on that. That was 700 pips running. And if you had a trailer behind it every 60 pips, let the thing breathe a little bit, you'll find that that'll move quite well. So happy days, happy days. Hello, selection. In Fib we trust. We definitely do. We definitely do. Selection, do I trade pound JPY? I do. I don't trade it as much as maybe as I should, but I always kind of have an eye on it because it's a very, very good market to work. And the reason being is it's pretty darn quick. But my go-to markets are two indices, which are FTSE and the DAX. I like to look at them, and I mainly trade the DAX, and that's because of the speed of it. But I always keep an eye on it. And then the two currencies that I trade the most is euro dollar and pound dollar cable. Now, I am trying to battle my demons with the US JPY, simply because it's pretty good late at night, and a lot of the guys want me to trade late at night. So, and I hate the pair. Not for anything other than I got badly bitten off it a few times, and it's sort of psychological that I have to sort of break down. And you'll find that your psyche plays a big part in your trading. The strategy is not what will make you money, guys. And I can't stress this enough. And all the messages I ever get is, just show me a strategy, I'll be all right. And I'm like thinking, it's a lot more than that. You know, simple strategy of price crosses the 20 and take it to the next support and resistance level is as good as any. The difference is are you going to put the right amount of money on? In other words, if you've got a very small account, you might have leverage on it, but if you over leverage the position, well, you're just going to blow up. The other one is, well, I'm wrong, but I'm going to hang on to this trade anyway, because pray to God, I might be right. Well, you'll blow up. So I actually talk about common sense instead. And common sense is what will make you a trader, not the system. Nearly got on one there. How did I get onto that from pound JPY? So to answer the question, yeah, I do. Love tails and hammers. Yeah. When you're looking at the candles, we discussed it in another one of these about volume and everything. Do I use volume indicators? I don't, because the candles will tell me what I want to see. If it's a grip big candle, well, there's grip big volume. It's that simple. If you see a huge tail and a small body, well, you can see the volume drop off. And these are exactly what you're just saying. A long tail candle with a small body at the bottom is telling you there's going to be a change. If you have a huge candle, you can see there's a lot of volume in it. But you've also got to be careful with a huge candle, because there might be a lot of volume in it, but it might actually be an exhaustion candle. And an exhaustion candle is normally 2 or 3 times bigger than something else. A little bit like the candle we were looking at earlier when you sort of showing you a fair value gap. It's called an overextended candle. And the reason it pulls back into that gap is just simply it's run out of steam and there's profit taken and traders caught on the other side of it. It has to pull back into it. And that's where a fib comes into it as well, because the fib will give you a defined entry and exit. And if you put it on a big candle, you'll often find that 50 gets respected over and over. So happy days, happy days. Jog on ice. Well, in fairness to the fella, he's been around a long time and he does talk some sense, but to me, I wouldn't slag him off. I really wouldn't. I would just say it's not for me. I'm happy with what I do. But what I will say is there is nothing new in trading. Nothing. So whenever you see the new wonder kid on the block with the wonder system, trust me, it doesn't exist. So happy days, happy days. Hello, Andrew. Hope you're well. Daddy levels are excellent. They define exactly what's going on in the chart. And just underneath that, SB is asking, what are daddy levels? Let me show you. Let me show you a daddy level. Just switch the indicators off. Switch that off. Put drawings back on. Get rid of all these drawings. Okay, if you take a daily candle, say this one, okay, or even this one, what you're trying to do is find some definitive levels you can work to, and those definitive levels are the lowest point the market has been to, the highest point the market has been to, and then you're looking at the open and close as well, which are here, and then what we're looking for is the middle point. Just put that there. There you go. Now they are key markers of the chart. Now you can go one step further. There is the grandfather levels, which is exactly the same on a weekly candle, and then you have the great grandfather, which is the monthly, and it's just really the parent of the chart. And the idea of it is, if we just drop a line here just so that I can kind of highlight this on an hourly, it constantly tries to look at the midpoint, but it can also show you directions of market and all sorts. And as you can see, these are from off this side of the line. Each one of these levels has been respected. Straight up, stalled, where it's been before, went through, stalled. The hammers formed, came back, stalled in and around the areas, and then broke down back to the midpoint. So without putting any big support and resistance levels in, they've actually give you some, you know, and then you can work your way through from it. You know, the next level up, you can go, right, okay, well, I've got a break at the top. How far is this going if it's going to return? Well, you put a fib onto it. Get my fib extension. There's a fib extension. Pull that back down to there. Okay. What do we know? Well, stalled bang on the 50. All the way down. We know that was the 76 because we were looking at it earlier on. So let's have a look at this level here. That's an extension point that I can squeeze up to because markets often turn round. Breaks through there, breaks the 100. It's coming here. Has this been there before? Let's have a little look. See if we can squeeze this up. And the dailies, where we are. It's not a million miles off though, is it? It is getting up into highs. There we go. Run that back. There's an extension. Bang on. Stall point. We whip that back. That came from that move. And that screaming back balances up. Because it'll always try and get to where the market has turned before. Why? There'll be pools of orders here. And those orders, there'll be some left behind. If for this, you could have stop orders that were there from people going short. And they forget about them and it runs up. Looks to find them. Does it over and over. And it's why the markets work like this. They're constantly looking for these orders. But they also want to be going in a singular direction. Which is why I'm not a big fan of trading two directions in a single day. You go with one direction and then you're not putting yourself at risk. So happy days, happy days. So where are we up to? Because there's loads here. I'm running out of space. Okay, EE, where are we up to? What's your thoughts on securing 10 pips versus running a trade as long as... I kind of just answered that, Eric, to be honest. When I look at 10 pips, 10 pips is not a maximum trade. It's a minimum trade. And it's basically for me just to go to market and I want something that's worthwhile. And if I'm not getting 10 pips, do I really want to risk it? You know, but also it gives it enough room to push up that you can pull your stop in when you take some money off, that the market's not just going to come and snap you out straight away. But you want to be trying to run them as long as you can, you know. But when you're day trading, this is a big thing. This, when you're swing trading, you're sort of looking to run as long as possible because you need big chunk of money. For the reason being, you're going to get stopped out a lot more than you are day trading. But when you're day trading, you're hitting and running all the time. So you get in, you get 10, 15 pips, get out, right? Why? Well, case in point, let's have a little look. If I drop this down to 15 minutes, there's 15 minutes. The thing has come down, it's shot back up. Down, shot back up. Down, shot back up. These little shoot back up, you know, that went down as far as there, and look how far it came back up. They're just going to take you out all the time. So you put a half decent target in, and then eventually one day it'll just keep on running. But when you're swing trading, you're anticipating all of these oscillations. So you do hold it a bit longer. So there is a big thing. If you're targeting 10 pips, you get in, you get your 10, you get out. But if you're going to pull your stop in and let it run a little bit further, great. But just be aware that it's going to get clipped each time. Maybe 2 in 20 trades will run for you. But those 2 in 20 trades will run quite a way. They'll pay decent money. So that's kind of my thoughts on that one. So let's have a look. RSI can catch you out if you haven't been following. Well, yeah, it can. And it's kind of why I was saying never use any indicator on their own. All indicators are lagging. They are genuinely lagging. So you need some other form of confirmation. Now, the best indicator on the screen is the price itself. And very few people look at it. They genuinely don't look at it. They think that it's a magic combination of, well, it's this indicator and that indicator, and it's obviously going to pay me a fortune. No. Price does one thing, right? It moves. That's it. All right. Now, your job as a trader is to figure out where it's going to move to. If you've got it locked between 2 levels, 2 decent support and resistance levels, and it doesn't matter where you get them from, as long as it's locked between 2 points, that price is going to hit one of them. Your job is to decide which one. So you're already at 50%. And that's when you look at your sort of indicators to get a guide of, well, it looks like it's pushing up. It hasn't gone to the top of the Bollinger Band. There's plenty of room up there. The RSI, it's got room to move up. The candles themselves, they're more chunky green than red, so the chances are it's moving up. Right, okay. Let's find an entry for this thing. Enter the market and then just manage it. It really is that simple. But we're constantly looking for the holy grail. The price has to do this to do that. Not really. Case in point, I get asked why I stage backwards rather than forwards. It's because I always expect to be wrong. I very rarely nail it on the head. It always moves 10, 15 pips against me before it goes for me. So my analysis is possibly correct in the sense I've got the direction right, but I haven't timed the trade right. But as long as it's trapped between 2 points, well, then I know I've got a safe place to play. I'll kind of explain it. Right. This is trapped here. Okay. Just get rid of that fib. And I'm just going to use what I've got in front of me. So we've got a level here and we've got a level here. Now, if you're coming into market and we're at the middle point of here, so we'll find the middle line. Okay. This is just very rough. This will kind of give you an idea of what I'm talking about. All right. So that's the start of the day. All right. So there's 8:45, 8:30 when I would start. Okay. If I'm deciding to go long, well, I get long pretty much straight away. All right. And that I've had very limited heat. Okay. However, if I decided I was going short at this point, well, I can still buy in up to these levels, which isn't that far. And then it ran straight the way down to the next level on the same day. So you've got one trader going long is going to score, and you've got another trader going short, and they're both going to score. The difference between them is patience. This one's impatient, gets in, gets paid straight away. The short one, because maybe you've seen this, has to sit and bear a little bit of heat, but then it comes back down. But the principle is it's trapped between that level and that level. Now, if I was stuck here, it would be sort of stuck between this level and that one. All right. So you're just looking at pivot points all the time is what I'm driving at. And then you take the lesser of two evils. In other words, you make an informed choice based on what you're doing. put in a half decent target, whether it's 10 pips, 15 pips, and you'll get that from your ATR. Because if you're coming to market and you're thinking you're going to get 100 pips on every trade, how? You know, if you're looking at euro dollar, the ATR is 90. So how are you going to get these massive 50 pip moves and everything? You're kind of pushing the extreme of what the chart is trying to give you. You want to be realistic with your conviction, but also realistic with your target. And if you're realistic, you find you win more. And maybe I'm wrong. I don't know. Maybe I'm wrong. So happy days. Show some love, folks. Well, I'm doing my best, John. I'm generally doing my best. So where we are? Move to Dubai and pay no tax. Yeah, but we can't drink in Dubai. That's a big issue. They'd have your hands cut off on the first day. So happy days, happy days. That's right. So let's have a look. See where else we up to. Okay. How does the Forex market work? Who collects real-time data? And I mean, where to broker? Well, they'll get that data from the stock exchange, the main stock exchange. So for argument's sake, London Stock Exchange will have the figures, and then they'll draw a feed from whichever exchange they're using, whether it's the one in New York or whatever, put in their own spread and their own costs and make a synthetic sort of price for market makers. Now, if you're very good and you're big, then you'll go direct access straight to market. But that's basically all it is. It's just a company will draw a feed and a price from the exchange. They'll add in their costs and make it, well, what I suppose is a synthetic price, which they then farm out onto the chart. And that's why some have different spreads and different pricing, etc. And it's not really something to worry about, I don't think. Again, it comes back to sometimes you can delve way too far into this. And ultimately, the price will go up, it'll go down, and it'll go nowhere. But it doesn't matter what the platform is you're looking at. It'll be the same, or the motion of the market will be the same. The only difference is the prices on the side. And to be honest, I don't even look at them. I couldn't care less, because I know they don't mean anything to me. What means anything to me is the shape of the market and how it's constructed, and whether or not the market is going to move to that turning point. When it comes to price, I very rarely look at it. And why? Because if I'm talking to somebody, they might be looking at Black Bull when I'm looking at IG, or they might be on CMC, and all three of them will have different prices, but the movement of the chart will be roughly the same. So just trade what you see. So happy days. Yes, I do put these out back onto replays. If I go too deep into it, they often just go into the squad. But most of these are fully replayed, Megan. So 100% risk management is what matters. Correct. I don't even call it risk management either. And I'll tell you for why. I don't think you should risk anything. You should invest. You're investing in yourself and you're investing in the chart. And that's a different mind concept. So what I see is common sense. You know, the first question you should ask yourself is, can I afford this trade? So if you've got a £500 account and you're looking at your trade and you think, oh, the stop needs to be right up here, you know, and it's like 100 pips away, which is very easy on the DAX. It can be easily 100 pips points away. And you think to yourself, pound a point, oh, 100 quid. Oh. And you might just say be able to open it on certain brokers if you've got the right leverage. But is it a sensible trade? No, it's not. Because you're putting too much stress on the account. And this is why I talk about position size being common sense. I see some people putting massive position sizes on, and they can have a massive run and they're going, yeah, I'm doing brilliant. Ah, look at this. And you see it all the time on Twitter, you know, and all that's run through my mind is it only takes one trade to wipe all of that out because you've over leveraged the position size, you know, and that's kind of why I work on sort of pound 1,000, 10p, 100. So the first question I'll ask myself is, can I afford it? Well, if you think I'm putting £100 up against a £500 account, that's madness. So no, I can't afford it. So what some people would do is they would pull the stop in, but leave the position size at £1 and say, well, I'll half the stop. Well, all you've done there is invite the market to take the money off you, because the stop has to be where a stop has to be. It has one job, protect the account. That's it. Has nothing to do with your trades. It's there simply to stop you blowing yourself out the water. That's it. Right? But it also has to be in a logical place. Now, to me, I hide it behind two structure points, either behind two support and resistance level, or be a support and resistance level in a moving average, or the outer Bollinger Band, whatever. But I'll always have two. And the hard stop will be behind the second one, and the first one, it'll be a mental stop where I think, am I wrong? And if I'm wrong, then I'll make a decision. And you should never, ever hit your stop. You should have the cognitive to get out when you're wrong. So that's the first thing. So what I would do in this instance is go, well, I don't want to pay 100. I'll half the position size to 50p and leave the stop where it's at. And then that way, the trade is still accurate. But now it's 50 quid for the trade. And if I still think that's too expensive against the account, I'll half it again. And then I'll ask myself the question, am I happy to pay this? And if I say yes, then I'll do the trade. And if it's no, well, I just can't afford it, so I have to let it go. And that's the hardest thing to get through in trading. Understanding how you manage yourself as much as how you manage the chart. So happy days. So let's have a look. Nick, am I right in saying that there is a good chance DAX gold cable soon turn and the trend? Well, it's like everything else. The markets will oscillate all the time. It depends on what you're trying to do. If you're trading sort of in the moment, day trading, it doesn't matter. It genuinely doesn't matter, because as I've just sort of shown you in that quick example, the market will go both ways. What I'll do, because I'll do for the squad probably tomorrow, I'll do a longer term analysis. Just drop us a message in the morning and just say which one you want me to do. A little bit like what I did for the sort of the US 100 and the FTSE recently, where I'll give it a long term view. And I'll do that for you, Nick. So no hassle at all. Mike, and after losing 14 years, can you tell strategies and patterns don't mean squat? They do, but they just have that place. One of the biggest failure points, and sort of I'll catch up with everything that's left before we wind this up. The failure points in the market is normally jumping from one strategy to the next. And it's why I'm not a lover of the buzzwords that are kicked around all the time, because there is nothing new. It's always support and resistance, and then you stick to your conviction of direction. That's it. You know, that's pretty much it. But how do you pick your direction? Well, that's a strategy, I suppose. How do you enter the market? That's a strategy. How do you select your stop? Well, that's a strategy. But it's all down to common sense. All right. Mine are very simple, you know, and the guys in the squad will tell you that. But it's based on what the price is doing at any one time. But if I was to say, right, well, today I'm going to trade the oscillator. Tomorrow I'm going to trade a Bollinger Band bounce. The next day I'm going to trade a fair value gap. The next day I'm going to trade volume. They'll all work. But there's going to be a time when I'm wrong. and that's when you change into the next one, and then it'll work, and then you're wrong, and you go around in a treadmill all the time. Whereas if you stayed in the same place with the same strategy, you will probably find that strategy works over time. Because what you're going to need to work out, and this comes from where your journaling comes into place, you find out what the win rate is. If your win rate is pretty darn low, and I mean below 50%, it's probably not a good strategy what you're working with, because you should always get it right more than you're wrong. And if you're not, when you're not reading the charts, you're playing a numbers game. And if you're playing a numbers game, you're gambling. Gamblers never win. So you want to find something that gets pretty much the direction right all the time. Now, I do it through multi-time frame analysis, and I do it by breaking it into what's called the power of three. Now, the power of three is I look for a trend on a monthly, weekly, daily. So that's the top sort of deep trend, if you like. I then look at a daily, 4 hour, and an hourly. That'll give me the mid trend, or the trend that's happening today. And those two are hinged together with the daily. And then when I'm looking to start wanting to enter the market, I'm looking for what's called the now trend. And that's from the hour, 15 to 5. And then I'm looking for confluence through the market. Now, the one that holds it together is the mid trend. If the mid trend is in alignment with the deep trend, then I'm in for a big target, because I'm going with the big money. If I'm going against the deep trend, I'm going to be conservative with my target. And then when I'm looking for entry, I want the now trend to be in line with the mid trend. And that tells me it's time to go. And then I'll break it down into sort of a +1, -1 to know when it's the right time to go. And +1, -1 is you have an anchor chart, which is say an hour. I like to look at the hourly. I look for confluence on the 4 hour above and the 15 below, and I see if there's some form of alignment. And if there is, good. I'll just look for a logical entry point, and in I go. Now, is that a strategy, or is that reading the market? To me, it's reading the market rather than a strategy. But I've done it for so long. It's the only way I know how to do it, which is why I don't chop and change, and I couldn't give a toss what other people do. I do what I do because I know it works for me. And I prove it. I've showed you my statements, and I build it up, and I trade in the moment in front of you guys. And let's be honest, you see me here every day. There's some guy question me, and he says, you work in a fish shop. I'm like, I work in a freaking fish shop. What planet are you living on? You know, I'm here every day, 16 hours a day, and I'm seen on camera for 16 hours a day. What chance have I got of another job? But some people are just fucking nuts. Anyway, story for another day. Bloody hell, how'd I get onto that one from 14 years? Myra, are you using the RSI? I use it every day. It gives me a good gauge of what's going on. But it's not the be all and end all of everything. So well, I enjoy this poker picture. I genuinely do. I love my job. I really do love my job. And that's why I do it. That's genuinely why I do it. Do you trade GB? It has a lot of it moves very, very well. Selection. It's a very quick market. The reason why I don't trade it is just because you probably habit forming. I'm a great believer in being a specialist rather than a generalist. Yes, I can trade any market. I genuinely can, and the guys do wind me up from time to time and come out with some obscure market and say, "Oh, I want you to trade," and I'm like, "Oh, please, will you not?" That's cruel, but I do it anyway because I like to please them. But if you stick with the same basket of products all the time, you kind of get to know it. And if you look at sort of decent market like cable, and there's nothing wrong with pound JPY, it'll pay you every single day. Just constantly look at it. The only thing that you need against them all is patience. Because if your setup isn't there at 10 in the morning, don't worry. It will come. Just sit and wait. And it might come in the afternoon session. And that's another thing about losing trades. It's the itchy trigger finger to get in. You're better off sitting on your hands than just pressing the button because you want to. And that's that. So happy days, happy days. So one question, when do you use a fib extension rather than a fib? I use them both, Jeremy. What I'm looking for is, well, let me show you. Let me show you. Let's drop this back onto here. You can find an extension. If, say, I'm looking at this move, for argument's sake, I can easily recognize sort of an overextended move within it, which is here. Okay, so I can see that the market's starting to push down. It's aggressively moved up, and then thump down it came, and then you've got a little bit of consolidation here that we can see. I'll get rid of that line because it's get rid of them all actually. I'll be able to show you this. So we can see the market is moving down. Now at this point, if I just draw a line across the top of there, where I'm going to start this fib from, this has not broken the top of there, and we've got a definitive low at the bottom, which is there. Now we can see that, and what you would catch my eye will be this 3 candle formation here. Why? Because they are bigger than normal. It's an overextended candle. So if I'm going to put on a fib, the first part of the equation is you need to know where that ended. And that will be down here. And I'll show you for why. Because there's the inversion and then there's the return. All right. And what that means is solid push down. It came back to the 50, came down, hasn't broken, but that showed the end of the move. Okay. And then you got the solid green going the opposite way, long tail to the bottom or longer than the ones at the top. So you can put a retracement on there. Nice and simple. Okay, so from here, we can put in some entry exit points, just like so. But this market, as we were looking at it at this point on this 15-minute chart, is down. And how do we know it's down? I'll show you in just a sec. All right. So we now got a defined chart. This formation and this move down, the fact that that's pushed higher, hasn't breached that, and then this is pushed up and hasn't breached that. It's kind of telling you the pressure's still to the downside. Okay. So if you're taking the retracement of this, you're looking at your 23 to get in, which is here. And then these are your take profit points. Okay. Now I run to mainly the 50. So that would be here. After this, it's done. But as the markets come back and it breaches the 50, looking to come further down, I'd be looking to see if it would break the 0. In other words, the 2 fixed points that initially started the retracement. Once it's broken that, I want to know how far it's going to go. So at this point, you can put on an extension here, there. And then if I put in the lines, it'll run to the 127 and the 161 as a final turning point. These are the decision makers. Well, what do we know? Stalled bang on the 127 and it's got bloody close to that 161. So from that single move, you can measure things out based on what you're seeing here. So you can take your retracement and then you see there's an overextended candle coming in, boom, up, slammed all the way down, pierced the bottom of here, has come back. you could start selling on all of these levels if you so wish, with these as maximum targets. So again, it's adding weight to your conviction. So your conviction is to the downside, but you're using a fib to measure out roughly where it's going to stall, and then you use those stall points to get in and get out. Hope that kind of helps. So let's have a look. Been there. I do great. I do my best. Oil analysis. Well, what I'll do is, because we run out of time, it takes us ages to sort of do a full analysis. And talking of analysis, you want to spend a good 15-20 minutes looking at a chart to get a feel of it and then make a true image. I mean, what I'll do is I'll look at that tomorrow, so keep an eye on the channel and I'll pull that up for you, and we'll see if we can do something with oil, because I've not looked at it tonight. So, oh, bloody hell, right, nearly there. Okay, I recently found out an imposter trader. Well, there's a few of them. Thank you for your in-depth response. You're very welcome, kid. You're very welcome. Lunch break's over. Well, it's not lunch here. It's late at night. It's 8:10, but I've got me coffee, so keep me awake. Got to get better at sitting on your... Exactly. Sitting on your hands is a great skill, Nick. It really is. To overcome the desire to get in is really hard. And it's one of the reasons I use hourly charts. If I'm looking at a minute chart, there's so much noise flashing and flashing around. You can almost talk yourself into a trade. And I mean, tell me in the comments. Tell me this. How many of you have done this? You've looked at a 15-minute chart for whatever reason, or even a 4-hour chart, and you think, there's nothing there. I'll look at it daily. There's nothing there. I'll look at an hourly. There's nothing there. I'll look at a 15, see if there's anything. Oh, the 15's looking not bad. Whoa, look, there's a trade on 5 minute. I'll take the 5-minute trade. Now, was that analysis or is that chasing the market? Now, to me, that's chasing the market. And in a 1 minute, you'll almost find a setup instantly. But as quick as you find it, it'll take it off you because it moves around so quick. There's nothing wrong with using a 1 minute for entry. And you can use a 1 minute to see the DNA of a candle. And it's actually really very good for that. You know, you can start looking at, well, was it one minute turned it green and the rest of it was red? And if so, was it the green one first and then the red started coming in? So that could tell you that it was an exhaustion candle for that sort of thing. But you should have your direction in place at around an hour to 15-minute mark. 15 minute is about the lowest I would go down to, but you should have all of your ducks in alignment at that point, and then just drop to a lower time frame to enter. And why? Well, if you say you want to enter on a 23 fib extension, support and resistance, or the break of a moving average, you go, right, I'm trading a 5-minute chart and I want to break above it. Now, one of my principles is I normally like a pierce of the level and then the next candle to hold above or below depending on direction. So the chart essentially shows its hand. And all that means is it's telling me the direction I want it to go in, you know, because very rarely you'll catch the very top of the market and very rarely you'll catch the bottom. You want the bit in the middle, and that's the bit that'll move. And that's what we're after. There's a very old saying, try and pick bottoms, you get smelly fingers. And that is so true. So true. So where are we up to? Process. Well, that's the next one. And that kind of goes back to what I was saying earlier on about position sizes. The money should never be in the equation, ever. If you put money first, you've already lost. Your process is what you're looking at. And if you can follow the process, then it doesn't matter how big your account size is. It really doesn't. Because once you've learned how to do the process, you can trade £100,000 account. You genuinely can. The hard part with trading £100,000 is you. And it's whether you can cope with seeing the P&L swings. Now, I came from industry of big numbers. And before I had my own business, I worked in an industry that had big numbers. So it never frightened me. So I'm not worried about seeing it on the screen, but I do switch it off. If I'm sort of got a position on and it's really racked up, I'll turn the P&L off, and that stops me from fiddling with it. Just another thing, but the actual process of how I'm going to get in would be identical across the board. I don't change just because the account's bigger. Doesn't make any difference. So happy days, picking bottoms. So that was that, guys. It's been a good hour or so. I do hope it helps. Do like, subscribe, share, all that sort of stuff. I'd like to see the channel grow. If you do find value, anything that you give goes to St. Cuthbert's, and that encourages me to do more of this. So thanks a lot, guys. Been a pleasure. As for the squad, I'll see you all tomorrow in the Discord, and we having a Zoom call for the New York session tomorrow. And that starts at about 9:30, but we'll be drifting in about 9:15. Happy days. All well. Catch you all soon.